Frequency Podcast Network. Stories that matter, podcasts that resonate.
A new Fed chair in the U.S. is set to step into the spotlight next week. Kevin Warsh will lead his first meeting on Wednesday after Jerome Powell's term came to an end last month. Powell, who was also appointed by U.S. President Donald Trump during his first term, spent the last year or so being criticized and ridiculed for not cutting interest rates. The latest inflation reading in the U.S. suggests rate cuts aren't coming anytime soon. And what does all of this mean for Canada? I'm Kris McCusker, and in this episode of In This Economy, we speak to Scott Anderson, Chief US Economist for BMO Capital Markets, based in San Francisco, California. Thanks for doing this today.
I'm happy to be here. Thanks for having me on.
So I want to start with the recent inflation reading in the U.S., topping 4% and higher for a third straight month. What do you make of it?
Yeah, it's not great news for a Fed that was looking to perhaps cut interest rates again in the not too distant future. So we've had 3 consecutive months now of elevated inflation. In fact, it's been averaging about an 8% inflation rate on an annualized basis over the past 3 months. So certainly moving in the wrong direction. Year over year, we're at 4.2% inflation. The Fed looks more at the core measures of inflation. So that takes out rising gasoline prices and oil prices and food prices out of the equation. And even on that basis, inflation is running at just under 3%. So the Fed's target on inflation is 2%. We're now over 5 years above that target. So this is not good news for lower interest rates anytime soon.
Well, and the thing that's interesting as Kevin Warsh comes into this position of Fed chair, starting with his first meeting next week, He's got a tough task ahead of him because the U.S. president has been calling for interest rate cuts pretty much since he came back to the White House. And it's not something that Jerome Powell, the former Fed chair, did. So how do you square this circle for Kevin Warsh? It's going to be tricky.
Let's tell it the nightmare scenario for Kevin Warsh, I think, coming into this first FOMC meeting. You know, as he comes in as the new incoming Fed chair, he's bringing a new element of policy uncertainty into the monetary policy mix. A question that we'll be looking at and the markets will be looking at is, will he be an inflation hawk or dove? You know, he came across kind of dovish in his Senate confirmation hearings a few months ago, but historically, Warsh, really, since he left the Federal Reserve Board in 2011, has actually been pretty hawkish, really concerned about inflation, the expansion of the Fed's balance sheet, and all those things. So it'll be interesting to see which Fed chair shows up at this first press conference. Also, markets will be looking for evidence that he's going to continue to help guard the central banks and the Fed's independence, as many economists think that's a very important thing for the Fed to do. So anything that might look like he may be subject to political interference from either the Treasury Department or the White House itself would be, I think, pretty bad for market expectations and financial markets in general.
Well, and it's interesting because the outgoing Fed chair, Jerome Powell, said he was going to stick around on the board to make sure that the Fed's independence remains intact. An unusual move, but clearly wanting to keep an eye maybe on the first couple of meetings.
Yeah, it's important to realize that the Fed chair isn't the only vote on the Federal Open Market Committee, which is the one that actually sets interest rate policy. So he only has one vote, but of course his vote tends to matter a little bit more than some of the other voting members. But he's going to have to do some convincing. I think we don't really expect right out of the gate for him to do a whole lot in terms of policy changes. We do think the Fed will be on hold next week at the first FOMC meeting of Warsh's career. But we do think they're going to make some baby steps towards a more neutral policy stance. So basically, getting rid of the easing bias in the FOMC statement that's been in place for a number of meetings now, that goes out, and the Fed kind of keeps itself open for either future rate hikes or future rate cuts, depending on how the war, energy prices, inflation plays out over the next several months.
Yeah, I mean, as I said, it's a tricky balancing act because there are so many unknowns at this time. And I mean, you sort of touched on it that Kevin Warsh is not a complete unknown because he's been on the Fed Reserve Board prior, but there's been kind of conflicting views. Is that fair coming from him?
Yeah, absolutely. So, Warsh was on the Federal Reserve Board as a member from 2006 to 2011 during the global financial crisis. And he actually left in 2011 over protests over the Fed's quantitative easing program. So, he supported the first round of quantitative easing right when the financial crisis hit and the initial expansion of the Fed's balance sheet and purchases of treasury bonds and mortgage-backed securities and agency debt to stabilize financial market liquidity. But those programs continued on beyond 2012. You had QE2, QE3, and then with the pandemic, you came into QE4, and the Fed's balance sheet exploded from before the financial crisis. It was around $800 billion. By the end of the COVID pandemic, we were approaching $9 trillion in the Fed's balance sheet. And so Warsh argues that this really helped contribute to the explosion in federal spending and the debt and deficit problems that the U.S. is now facing. And he's really anxious, based on his Senate confirmation hearing testimony, to reduce the balance sheet of the Fed and kind of take it off the front page in the newspapers, and kind of reduce its influence overall over both fiscal and monetary policy.
And just, I mean, for people who don't know, the quantitative easing is sort of a prop up. Is that a fair way to describe it, or how would you describe it?
Yeah, it was an additional policy tool that the Federal Reserve rolled out right after the financial crisis began in 2008. So they had already dropped interest rates to what the Fed calls their lower bound. They dropped the Fed funds rate, which is the Fed's policy rate, to 0%. But beyond that, they weren't able to, make it negative, and they thought the financial markets needed more support. So Ben Bernanke, who was Fed chair at the time, came up with this idea of quantitative easing, where the Fed would buy longer-term Treasury bonds, so the 10-year, the 30-year Treasury bonds, et cetera, and help bring down longer-term interest rates. They also bought mortgage-backed securities and agency debt from the housing market to kind of bring down mortgage rates and support the mortgage market. And housing market was the epicenter of the financial crisis back then. So most economists think that was pretty effective. It really helped with the forward guidance and bring down those long-term rates. But I think Kevin Warsh believes that these programs continued a lot longer than they were needed when the economy was no longer in a state of emergency and financial markets were no longer in a state of emergency and weren't really rolled back quick enough, in 2012 and beyond.
The other thing that's going to be interesting is when Kevin Warsh was introduced as the next Fed chair, the U.S. president made a big point of saying that he'll be independent. He's going to make his own decisions. This is not my circus, so to speak, even though the U.S. president was extremely critical of the outgoing U.S. Fed chair and the fact that he did not cut interest rates. So it's going to be interesting because I think given the current landscape, a cut is not in the cards anytime soon.
No, the markets certainly don't think the Fed's going to be able to cut here with inflation running as hot as it is. I think the best case scenario for Kevin Warsh and the president is probably interest rates staying where they are as the Fed kind of takes a wait and see approach. There are probably some FOMC voting members that think, the Fed should try to look through this energy price shock as long as it doesn't spill over into other categories of prices beyond energy, and if it doesn't seep into what economists call inflation expectations, or things like wage negotiations with employers. If people start to factor in higher inflation longer term, it becomes much more insidious. Something that happened in the 1970s, and then it took Fed Chair Paul Volcker to come in 1979 and really put a slam on money supply and create a deep recession downturn to try to break the back of inflation. The Fed wants to avoid that problem this time around, so it's better to nip these inflation problems in the bud early rather than let them linger and fester.
And let's just remind everyone, these inflation problems, at least in part, are because of the war in Iran that some argue is a war of choice, so to speak. This was not something that was necessary.
Yeah, it seems like we're kind of shooting ourselves in the foot with some of these economic policies. Last year, it was the tariff and trade uncertainty that was seen by many economists, including our shop at BMO Economics, as a stagflationary shocks, kind of slowed down our growth rate as well as pushed up prices. This war in Iran, this energy price shock is expected to be very similar, putting the downward pressure on consumer spending as consumers see their wages failing to keep pace with rising prices. It's a really sapping the consumer's ability to spend here. They're really tapping into their savings. They're exercising their credit cards a lot more to try to keep their head above water on their budgets, given the rapid rise in prices. And so it is a big problem right now for the Fed, and the Fed's trying to take a wait and see approach to see how long this, it's really going to depend on how long the Strait of Hormuz remains effectively shut down, and how much that plays into oil prices and energy markets. Most economists in the markets itself believe that we will get some resolution on the strait, within the next, maybe quarter or so, and then that could allow for somewhat lower energy prices by the end of the year and help start to mitigate some of these inflation pressures and maybe open the door for a possible rate cut next year. But it's a very uncertain period right now, and it really depends whether the war escalates further. If we see damage to oil and energy infrastructure in the Gulf, permanent damage, that would lead to much worse scenarios and outcomes. So us, like the Fed, are really playing a scenario game right now, playing out different scenarios on oil prices and inflation to get a sense of where we might ultimately land. But we're just going to have to be nimble here, and the Fed's going to have to be nimble in terms of policy stance and rates.
How much of a factor has the US dollar been as well? Because I've been reading predictions now, it feels like for years, that, well, the US dollar's run is going to slow, it's going to cool. And I mean, it seems to be one step back, two steps forward.
Yeah, the dollar's been pretty stable here. I mean, there's been a flight to safety a little bit to the dollar since the war broke out, which has provided some stability. It's interesting, though, last year with the trade war and tariff uncertainty, we actually saw a weakening of the dollar, about 10% decline in the trade-weighted dollar last year. But it's been kind of stable since then. And so we'll have to see how this plays out. But there's still, the dollar is still a global reserve currency, although it is losing a little bit of its luster. I notice a lot of central banks are buying more gold these days and adding to gold reserves rather than dollar reserves. We've seen countries like China pare back some of their holdings of U.S. Treasury bonds. So at the margin, the dollar is losing a little bit of its luster, I think, among some folks. But overall, there's not a lot of replacements at the moment that can step up into the dollar's role. So I think the dollar still has some legs here. But again, if we take our budget deficit and debt for granted, I think there'll continue to be pressure on the dollar going forward.
And things will be a bit different under Warsh.
So a couple of things that he's mentioned recently in terms of changes at the Fed and how the FOMC meetings are run. One, he talked about perhaps getting rid of forward guidance in the statements. So that's something that Ben Bernanke, kind of solidified during the financial crisis to try to, manage longer term interest rate and inflation expectations. So Warsh is not a big fan of forward guidance. He's kind of downplayed all the FOMC members going out there and giving frequent speeches as well. So I expect he may make some moves, probably not at the upcoming meeting in June, but maybe in future meetings, making some changes there. He's also talked about reducing or maybe eliminating, post FOMC meeting press conferences. So that's another change that Ben Bernanke brought in during the financial crisis and was continued with Janet Yellen and Chair Paul. So that might be a pretty big change for the markets and might actually increase some of the uncertainty around some of these meetings for the markets around what the Fed might do. The other thing he's talked about is, the other thing they do at these FOMC meetings every quarter is they update their economic forecasts on inflation, the unemployment rate, GDP, as well as their what they call the dot plot, which is, the FOMC participants kind of penciling in where they think the Fed funds rate would be at the end of the next 3 years. And so the markets do look at that quite closely, but he's not a big fan of the dot plot either. So that might be something that might be going the way of the dinosaur going forward. The other thing I'd say is he's also talked about, the Fed doesn't have an explicit inflation target at the moment. It does, over the medium term, target core PCE, which is the Fed's preferred measure of inflation that excludes food and energy, at around 2%. But Warsh has talked about a new inflation target metric looking at the Dallas's Fed trimmed mean PCE, which kind of throws out the most extreme changes both on the higher end and the lower end for prices. And importantly, that's running a lot lower right now than the core PCE. The core PCE latest measure is about 3.3% inflation. The trimmed mean is running at 2.4%. According to the Dallas Fed. So that, if he does look at that lower measure, that might mean an earlier rate cut for the Fed than if they were using the previous target. And again, the other thing I think we'll be really interested in seeing is what does he say about the balance sheet going forward. He's talked about shrinking the balance sheet. In the past, he's talked about reducing the Fed balance sheet by as much as 5% of nominal GDP, which is around $1.5 trillion. So we'll see what he says about that, if he maintains that view. That on the margin would be a bit of a tightening of monetary policy, but probably only equivalent to about a quarter point rate hike from the Fed. So most economists don't really see that as a major tightening of monetary policy, but it's something that the markets will be very, very keyed in on.
If I just oversimplify what you've just outlined here, it sounds like less communication.
It does. A little bit less communication, a little less guidance from the Fed, a little less transparency, perhaps, in terms of their methodology and how they come to their rate decisions. So, it's almost like going back, really to the Greenspan era or even before that for the Fed if they make some big changes in this direction. So, of course, he's got to get buy-in from a lot of the other FOMC voting members to make some of these changes. But it'll be interesting to see if he starts taking steps in that direction.
I also want to ask you, we know that when the U.S. sneezes, Canada catches cold. So how does this potentially impact Canada? If Kevin Warsh goes ahead with, the way it looks right now, that there would likely be a interest rate hike rather than a cut. Our Bank of Canada this week decided to leave interest rates unchanged and didn't really offer any insight on what comes next because there are so many unknowns. I guess I wonder how the Canadian economy could potentially be impacted by Kevin Warsh moving in as the Fed chair.
Yeah, so if the Fed does go down the more hawkish path, and right now the Fed funds futures market has fully priced in 1/4 point rate hike from the Fed by the end of this year, and about half of a rate hike kind of priced in for next year. So the markets are certainly leaning toward a more hawkish Fed right now and potential hikes. I think that's not great news for the Bank of Canada or for the Canadian economy. Part of the reason why the Bank of Canada has been more reluctant to hike rates here at the latest meeting is certainly because growth is a lot weaker right now in Canada than it is in the United States. And, one thing that Warsh is benefiting from is a stabilizing labor market. We actually saw a pickup in job growth in the United States. It looks like in the second quarter, U.S. GDP growth is going to be somewhere around 2.5% or 3%, somewhere in that range. So the U.S. economy is still really strong right now, mainly because of AI investment in the productivity increases we're seeing there, in investment we're seeing there. And the consumer has actually held up among higher income households because the stock market seems to hit record highs all day long. But for the Canadian economy, higher rates in the U.S. is going to put more pressure on the Bank of Canada to hold the line on rates and perhaps raise rates as well, even if they do see weaker growth. So again, Canada still depends a lot in terms of exports to the United States. So a strong economy is good news for Canada, but higher rates could be put a bit of a damper on that.
Well, and I'm just seeing a headline here, interesting, from the Fed that Chairman Warsh will hold an FOMC press conference June 17th. So he's starting off on a communicative note.
Well, that's good news, and we did anticipate that. Any changes he introduces will probably be, kind of piecemeal and a little bit at a time, well communicated before they make the changes. The worst thing the Fed could do here is, do something that catches the markets by surprise, and could create a lot of volatility in interest rates that we're already seeing in terms of daily changes and because of the headlines coming from the Persian Gulf and what's going on there. We don't need the Fed to add to that noise and volatility.
Fair enough. Thank you so much for doing this. I really appreciate your insight in this sort of preview, I guess, to the new Fed chair in the U.S. I could talk about this for days, but we just don't have the time.
Got it. Great. Thanks so much. Appreciate it.
That's Scott Anderson, Chief U.S. Economist for BMO Capital Markets, based in California. That wraps up this episode of In This Economy. You can listen to other episodes anytime on the Seeker app. Please rate, review, follow, and share. I'm Kris McCusker. Thanks for listening.